Trent Bradshaw, Brandon Rogers with Bradshaw Financial Planning, and thank you for joining us for Mind Your Money.
You get a shiver in the dark, it's raining in the park, but meantime.
We're coming to you today to give you an update on the fourth quarter reallocations that we're doing across the board on the portfolios. There were some changes that we put into the portfolios for the fourth quarter, and we'll kind of touch on why. Globally and also domestically, we're obviously seeing some evidence that the economies around the world are slowing at this point. We're hoping corporate profits come out and actually exceed expectations. Expectations are for negative year-over-year growth in corporate earnings, but hopefully we'll get positive earnings, and that'll be a catalyst to move the market back in the right direction. But I want to talk about interest rates, because interest rates is going to be the near-term catalyst, along with obviously the trade war. Talks with China are getting ready to start back up, I believe, next week. So hopefully we'll get some additional positive news out of that we're moving in the right direction. Both the United States and also China need that deal done, so hopefully we can get it done. But when you look at interest rates going into the end of the month, right now we have in excess of a 90% chance of another 0.25% cut. In addition to that, we got the December meeting, which I think is around December 11th. December 11th meeting is statistically about a 52-53% chance that we'll see a rate cut there too. So by the end of the year, we're looking at 50 basis points or 0.50% reduction in the Fed funds rates. And in addition to that, the January meeting, we're seeing in excess of a 30% chance that we'll see another rate cut in January. So we could get back under 1% on the federal funds rate at some point in the future. Will that be enough fuel to move the market in the right direction with all this uncertainty that's going on right now? We'll have to wait and see. But what does that mean for our portfolios?
Yeah, so some of the major changes that we made in part as far as the equity portion of the accounts is that we brought in some more defensive type stocks, some dividend payers, some gold, some real estate utilities, consumer staples, which is kind of like your household products that everyone uses regardless. So we definitely have some of the defensive equity positions in there based off of this uncertainty that's around. Obviously, volatility has been here. It's been here all year. I think it's going to continue to stay, especially going into the election next year. So that's really why we got to keep our thumb on the pulse of the market and really make these changes as needed. Indicator wise, everything as far as short term, intermediate term, long term, kind of all looking at green lights right now. So again, that's why we're still exposed to the equity side, but we are taking a more defensive approach when it comes to that portion of the portfolios.
And we'll remain nimble. If we need to make adjustments, lean more towards fixed income at a given point in the future, we'll do that. But give us a call, join us on social media, send us an email, whatever, if we've generated some questions. And Brandon Rogers, Trent Bradshaw, Bradshaw Financial Planning, and Mind Your Money. Thank you and have a wonderful week.